Hey everyone, welcome to the Freelance Bootcamp Experts Live. I'm Rachel Cross, and today I am joined by Kevin Christensen. He is the founder of Aligned Financial, and I'm really excited for this discussion. We're talking about investing for solopreneurs. So when people, leave their full-time jobs, or maybe just never had a full-time job but have their own business, a lot of people miss this piece of the puzzle, which is setting up for their own retirement, planning, budgeting, all of that good stuff. So we're going to dive into this discussion with Kevin. But first, because it's a highly regulated industry, he has a disclaimer that he has to present to us first.
Yep. Just promise me you won't fall asleep, but here it goes. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. Rachel Cross, Aligned Financial are separate entities and not affiliated with LPL Financial. Content in this material is for general information only and not intended to provide specific advice or recommendations or a substitute for specific individualized tax or legal advice for any individual. We suggest that you discuss your specific situation with a qualified tax or legal advisor. No strategy assures success or protects against loss.
Perfect.
Fun
Your
stuff.
business attorney would be proud. My attorney would be proud. Everyone's covered. Thank you for sharing that. Kevin, you founded a company in the middle of COVID, which sounds nuts. So can you tell us a little bit about that? What was that like?
Yeah, it was. It's been an interesting year for sure. I made the decision about a month before the stay-at-home orders. So April 1st was my official launch date. No joke. And my wife and I actually, what's that?
In the thick of things, like right in the beginning.
Oh yeah. My wife and I had a baby 10 days later on April 11th. So that was the biggest thing for me, just trying to plan ahead, knowing the baby, was coming. His due date was actually the day before, April 10th. So luckily he was on time and didn't come a couple weeks early when I was just launching. But and then of course you add in COVID and a recession and other things. Things were a bit hectic to say the least. But it was a good, if I could go back in time and change it, I wouldn't. It was a good experience. It was exciting, challenging. And I'm now at the point where things have calmed down. I have the foundation, set, and I'm ready to continue growing.
I love it. Well, congrats on the new baby. And you kind of gave birth 2 times, really, during COVID.
Yeah, twins that were 10 days apart.
Yeah. I'm sure your wife would have take some note of me saying you birthed anything, to be fair to her.
Sure.
So your company's called Aligned Financial, and you have a really interesting way of working with your customers, and it's based on values. Can you tell us what that means? How does that work? How do you align your values with your investments or whatever else is going financially?
Yeah, great question. So when we were thinking about what we were going to name the company, that was an important piece of it, was aligning your values with your money. And so our little motto is your money, your values aligned. And so that was the premise of the name. And it can come in a lot of different forms, but typically our process is sitting down with a client, now, of course, over Zoom, not in person,
right?
But really getting to know them, what's important to them, what their values are, before we get into talking about stocks and bonds and rate of return and all the financial jargon. We think that that's important to start the relationship on, to take the focus off of just the finances and really on more of the qualitative side.
I love that. Sorry, I cut you off.
No, it's fine. So then we get into, the actual financial plan and the roadmap and talk about goals and, where they are now versus where they want to be. And so that's more of the traditional sense of the financial planning, but really starting with the values. And then that trickles down to how we invest our clients' money, making sure that's aligned with their values. And typically that's through ESG sustainable investments that only invest in responsible companies. So that's just a kind of a high overview of how we do it.
That's so interesting. And I know you and I were talking earlier, and we talked about if a client isn't sure about their values, you also have some exercises to help them walk through how they're spending their money currently in relation to what they say are their values. Can you tell us a little bit about that?
Yeah. So I actually had done a webinar workshop a few months back about it. But you take a piece of paper, you list your values 1 through 10. And I actually have a whole worksheet that I'm happy to send out if you're curious to learn more. And I give some examples of values. Maybe it's family, career, friends, your spiritual life, your health. There's a lot of different things that could be important to you. But you rank those 1 through 10. In the next column, you actually write down how much money you spend per month on each of those areas. And then the third column is how much time you devote to each of those values. And I know it was eye-opening for me when I, first went through this exercise, and I got a lot of similar feedback as well, where
That
you
sounds
think
amazing.
that you have one value, or maybe these were my top 3 values that I thought, but your time and money tell you otherwise.
Yeah, I think that's so true. I've heard that before. Either you can look at your calendar and that's going to be a reflection of your values, or you can look at your bank statement.
Yeah.
And same idea. I know I do a values exercise with my clients as well, and it's helpful to make sure that our behaviors are aligning with the things we say are important to you. So I love that we can also align our money with what we say is important to us.
Yeah.
You are an independent fiduciary, which is a big word. And I know I only learned about what that was a few years ago. Could you explain to anyone watching who doesn't know what a fiduciary is, how that's different from a regular financial broker?
Yeah, definitely. So by definition, I legally have to put my client's best interest before my own, which seems a little strange to say that out loud, because you would hope that every advisor has to operate under that same capacity.
No.
But unfortunately, that's not the case. There are some new regulations that are helping define a fiduciary, but that's essentially what it means. And it's something that I've done my entire career, and it's still hard for me to believe that other brokers don't have to put their clients first. But that's really the premise of it. And there's a couple designations I have that also define me as a fiduciary. One is called the CFP, it's the Certified Financial Planner, and the second's the AIF, the Accredited Investment Fiduciary. And so those basically hold me to a higher standard, and legally require, even though morally I would want to do the right thing anyway, I'm also legally bound to that.
Oh, that's so good to know, because I know I didn't, before I knew what that was, I wouldn't have known that I want to specifically look for someone who's a fiduciary because of like you said, you'd hope morally people would do that, but this is kind of an extra layer of, okay, now legally you're also bound to that. So when I think about, you have this obligation, which you personally would have anyway, whether you were a fiduciary or not, to your clients, and then you have this values-based business. Can you give us an example of how that's affected maybe how you advise a client related to their portfolio, or maybe change something, like you inherited a client that had an existing one and you changed it?
Yeah. So I've had a lot of these conversations since April with the new company, and repositioning a lot of strategies and portfolios. One conversation that stands out in particular is a lady who's been a client for probably 3 years, and I had actually never had a conversation with her about sustainable investing. That's something that that's a big part of our new venture. Our old company, it's an offering that we had, but not something that we actively promoted.
Okay.
So I had the conversation with her, and it was over the phone. She lives overseas, so it wasn't face to face or even Zoom. So I couldn't see her face, but I could tell that she was very interested, very passionate about it. And so I repositioned her account. Now it's in line with her values. And I could just tell the tone and the conversation and the relationship just changed. It was definitely enhanced. And the cool thing about that is not only is she now in a sustainable portfolio, but there's also other benefits that she's realized as well, and even all of our clients, where we've done a lot of research on all these types of investments. We've benchmarked and compared our portfolios to other strategies, and more often than not, the performance is better.
Wow.
The risk is less, and we saw that in March with the market correction. It was a bear market, so these investments tend to hold up better, and then also the internal fees are historically lower as well. So it's
so interesting.
Yeah.
Well, that's great, because I know I don't know how to research any of that. And so that's why I think also just the benefit of having someone like you who's an expert in it, whose day-to-day job is being kept abreast and researching what is going on in the market. And when it comes to things like sustainable investments, knowing which ones can really not only benefit your clients, but also in some way or another doing good in the world. So I think that's really cool. Yeah. When you have a lot of clients who are entrepreneurs, and when you talk to them either about leaving their job, or maybe they've never had a full-time job, but they're now thinking about investing. What are some of the most important things that those of us who are now our own bosses, our business owners, what should we be considering when it comes to our financial futures?
Yeah, there's a few things. The first thing I would say is on the cash or the saving side, and that ideally is done before you make that leap into either freelancing or starting a business, and that's a few different things. So one is a budget, and that could be a personal budget and or a business budget. Also on the business side, it's looking at what's your cash flow projection. I have a product or I have a service, how much do I think I can realistically bring in terms of revenue? What will my expenses likely be? And then the third thing is to kind of help with that, if there is some sort of shortfall, is to have money in the bank. So, you want to have 6 to 12 months of cash in the bank to cover expenses for those 6 to 12 months. And that's in case we have a global pandemic, which, a lot of people are being tested this year. Maybe revenue is not what you thought it would be. Maybe you have a health issue, or you have expenses that weren't planned. There could be a lot of different circumstances why you would need that cash, but that's just a buffer. You want that runway when you do start your own company.
Absolutely. I always advise people who are thinking about leaving a job where they're getting paid every 2 weeks and it's the same amount every week, to going freelance. While I know that it can be actually more lucrative and more financially stable than working for someone else, you just want to be wise about it. And I think for me, telling people that you should have a 6-month savings runway, or ideally a year, it's not just about this fallback. It's more about the peace of mind that it creates, so you can focus on this new business that you're launching, so your mindset is in the right place and not constantly worried about what's going on in your bank account. So I love that advice. When it comes to entrepreneurs and solopreneurs launching their businesses, you also have seen, I think, some common mistakes. What are some of those that you can share with us so we know what to avoid when it comes to our investments and our finances? Yeah.
So I think, I've seen a lot over my career. I think the most common would apply to a solopreneur and really just people in general. And that's waiting too long to start to save for retirement.
Yeah.
So especially being on your own, you don't have the ease of contributing, into your 401k every paycheck and getting a company match. But there's also a lot of other things that compete for our time. So, as a new business owner, you want to invest in your business, invest in yourself. There's a lot of startup costs, so it's tough to save for retirement. And of course, you add on family and kids and taxes and everything else. There's a lot of demands out there. But starting early does pay off in spades. It makes such a huge difference. You look at the stats. Even waiting 5 or 10 years can make it very, very tough to try to catch up, let alone if it's 15 or 20 years.
Right.
And so that's one of the biggest mistakes I think I've seen. Another one, which is somewhat similar, is having too much of your net worth in your business. And, there could be a lot of things that happen. Maybe there's a competitor, or you have a health concern, or you just think your business is worth more than it actually is.
Yeah.
And you think, I can't tell you how many times I've heard, from people I've talked to, that my business is my retirement plan. And it can be a really great retirement plan if your business does well, but it can also be catastrophic if if any of those things that I mentioned actually occur. So it's important to diversify. Having a lot of your net worth in your business is fine, but you also want to take some chips off the table and diversify into other retirement accounts.
Yeah, I love that. I think both the advice for starting early, because I know I have a few clients I've talked to who are in their 20s, and they're like, oh, I don't need to save until I'm like 40, right? And they're missing out on these critical, 10 to 15 years of building their portfolio. And then also your second point about maybe even if you're not over leveraged in your business, counting on the business itself as the retirement sounds crazy to me, but I'm probably less risk averse, but I think that's really good advice. When it comes to us again, who are solopreneurs, how much should we be saving? Like, are there any good rules of thumb or like formulas we can use to try to figure out how much we should be saving for our retirement?
Absolutely. So it is pretty case by case, just depending on your individual circumstance. But if you Google it, you say, how much should I save for retirement? You'll probably find 10 to 15%, which is pretty standard.
Okay.
But it depends on your age. It depends on how much you currently have saved, and also what you think or what you would hope your retirement looks like. Do you want to work until 65? Do you want to retire early? Some people say they'll never retire. They're just going to work until they can't, maybe in their 70s or 80s. So it does depend on several things. One good rule of thumb is if you haven't yet started saving, take your age and divide by 2. And that's likely how much you need to save. So that 10 to 15%.
So if I'm 40 and I'm more than that, but we'll just use that. So 20%?
20%.
Of my
that's
overall
of your gross
annual?
That's of your gross income.
Gross income. Okay.
Yeah. So, I mean, you wouldn't have to say, total gross business revenue, but at least, gross income of the income you're taking from the business before paying tax. And you can see that, if you wait until 50 or 60, that becomes a pretty large number.
Wow. Yeah. That's great to know. And then you can also see how 20% is a lot more than 10% if I had started earlier, or 15% if I had started when I was 30. So, and then that's the percentage I should be saving every year until I retire, theoretically, as a general rule. Again, not knowing my desired age of retirement and the kind of lifestyle I want to live when I'm retired.
Right. That assumes you'll just maintain your same standard of living in retirement. Of course, there's other, factors. It's a little bit oversimplified, but just as a kind of a general, number to shoot for. But I would also say, don't just settle for the minimum of 10 to 15% just because that's what the experts say. There's this whole, it's called the FIRE movement. It's financially independent, retire early. There's a lot of blogs and articles and websites devoted to FIRE. And it's people saving up to 50, 60, 70% of their income.
Wow.
In order to have the option to retire. It doesn't mean they do. Some retire in their 30s or 40s. But just having the option to retire gets back to that peace of mind and that mindset that you mentioned before of knowing that I don't have to work if I don't want to or if I'm not able to. And so if you compare saving 15%, that will take you 43 years to become financially independent. Right. So if you start out fresh out of college, you're on that track for age 65, which is, the average retirement age. But if you can bump that 15 up to 50%, which is very aggressive, that drops the number down to 17 years.
Wow.
So if you think of how old you are today, add 17 years, I mean, that could be a life-changing age to have the option to retire. You know, that you could be 47 or 57 years old and have that option if you're, you know, in your 30s or 40s right now. So I would encourage people not to just settle for saving 15%, retiring at 65, because that's what most people do. There are other options out there. It does take a lot of diligence and you know, responsibility in order to do that.
Yeah.
But you can really chart your own path and create your own future depending on how you see your working and retirement years.
Well, and I think, you know, your point is, because I'm sure, I know I'm thinking like 50% feels like a crap ton. But the point is, you don't have to stick to the 10 to 15% that is the normal template. The more you contribute, and it might be 1 year you're able to contribute more, and maybe the next year you go back down, right, to 10 to 15%. It's not like you're you know, shackled with that number for the rest of your working life. But just to know, the more, even just to have that in our minds, right, the more we save and the more we put into those accounts now, which have a lot of tax benefits, by the way, the more then flexibility we have on the back end of our careers, right? As far as when we want to retire, how we want to retire, the amount we want to retire with. And I've never heard of that FIRE. So financially independent, retire early.
Yep.
That's great. Well, I know when I was starting, I was going from a corporate America job where I had a 401k that I had transferred through the different companies I worked for. And I was just told, go open a SEP IRA, self-employed pension IRA. And I was like, great, I'll do that. But to be honest, I didn't know any of the other options of, you know, retirement accounts that I could have started. So I would love for you to give us a kind of an overview, especially, and I don't know if there's a difference between when you're a sole proprietor versus a, you know, LLC or S Corp. So can you walk us through some of the accounts that are available to us when we're self-employed?
Yeah. Well, you're not far off with the SEP IRA. That's a great option. And that's typically the most common as well. So think of a SEP IRA as a jumbo self-employed IRA. So you can contribute more than a typical IRA.
Okay. Like a traditional or a Roth, you mean?
Yeah, exactly.
Okay.
Yeah. So
and it's pre-tax dollars, right?
It's pre-tax.
Okay.
Yeah. So it's similar to the IRA, but you can only put $6,000 per year into an IRA per person.
Right.
And so, and you have to qualify for it. There's different provisions, but a SEP IRA is a great account. It's easy to set up, just like an IRA. It allows you to put about 20 to 25% of your income away for retirement. You get a tax deduction for the money that goes in. There are certain restrictions about not tapping into it without a penalty until you are retired, which is typically age 59 and a half. But you're saving money for your own future, and it's a great account. There are other accounts out there. One's called a solo 401k. So just like your experience with a 401k for a big company, you can actually have a solo 401k if you're self-employed and don't have employees.
Okay.
You can also add a spouse
can you
on.
Be a sole proprietor or an entity, your business?
You can.
Okay, so no employees, solo 401k.
No employees, yeah.
With a SEP, can I have employees?
You can, but they have to get the same percentage that you do. So it really depends on a lot of different things. But if you have employees, typically just a 401k is the best option.
Okay.
There's also something called a simple IRA that can work in some situations.
Okay.
But the issue you run into with employees is not only is there now discrimination testing, there's a lot more administration, but you have to put money in on their behalf if you want to be able to use the plan as well.
As an employer. Okay, good to know.
So being a solopreneur or having no employees does make it a lot easier. So the solo 401k is similar to a 401k. You still have the same contribution limits, which is $19,500 this year, as opposed to an IRA of only $6,000.
Right.
But there are some pros and cons between a SEP and a solo K. So that's one area that I help my clients determine what the better option is for them. And then there's even, we alluded to the IRA or the Roth IRA. So those are individual retirement accounts. You don't have to be self-employed, but you can still use them if you are, and if you meet the certain criteria. And those can be really good options as well. Even if you rolled your 401k into an IRA, you can continue to contribute to it. But there are the income limits, which create a problem. As your income increases, you can't contribute enough for comfortable retirement. And so it requires one of these other types of plans to be able to sock away even more.
Perfect. So SEP IRA, 20 to 25% of your gross income?
So it's actually, it depends on the entity. If you're a sole proprietor, it's actually going to be based on your net income. So after your expenses. If you're an S corp, for example, it's going to be based on your W-2 wages.
Okay.
So if you're taking a draw and you're not paying payroll tax on that money, you can't contribute that to one of these plans.
Okay, perfect. Yeah, I have a SEP IRA, and then I just started a solo 401k as well. I know for me, so I could also have an employer match. So my company can match my individual contribution as the sole employer of my S corp.
Exactly.
So that's a new option that I learned about last year, which was kind of cool. What other, I know, a lot of this is probably just also going over people's heads, because I know it took me a long time to grasp them. So you have some resources that can help people. Can you give us an idea of some of the things that you can help some of these solopreneurs or freelancers with?
Yeah. So I do offer a free consultation. I'm happy to chat with anyone who's tuning in today. And like I said, it's very case by case. So it depends on your specific situation, your values, your goals. But I can help lead you in the right direction and help you understand. I mean, it takes a lot of research and a lot of time to study up on all these different options and different investments within each option. So I'm happy to be a resource and a guide for you with that.
That's awesome. Do the rules vary state to state, or is it like if you're in the US, it's kind of the same options are available to you?
Yeah, so these are basically at the federal level. So taxes, vary state to state.
Sure.
And so there could be additional state income tax savings depending on the state, like California.
Right.
But typically it's looking at, the whole country.
Perfect. And I know one thing, when you were comparing SEP or solo 401k to like just a traditional IRA or Roth, Roth, for example, is post-tax dollars, right? So I might have a benefit to it, but I've already paid whatever taxes I'm going to pay on that money, versus my SEP or solo 1k, I'm contributing pre-tax, meaning it's not actually being counted towards my net income as Rachel for the year. Yeah.
So a Roth IRA, and there's actually a Roth 401k, and there's even a Roth solo 401k option.
Okay.
A lot of people do these plans because they want to reduce their taxes now.
Yeah.
But if you're on the younger side, another good thing is right now tax rates are low. So a Roth could make sense for people to pay the tax now.
Okay.
The money goes into these plans after tax, but then they grow tax-free throughout, your career when it's invested, and the money comes out tax-free as well. So on the traditional IRA, SEP IRA, 401k side, you get the tax benefit today. It grows tax deferred, but then when you take the money out, it's ordinary income tax, just like if you were collecting a paycheck.
Good to know.
So it can make sense to explore a Roth option, but it just depends on specific tax situations, and some of it's even preferences. Some people hate paying taxes and they want to reduce as much as they can now. Yeah. Other people don't mind paying a little bit more today, knowing that they may have 20, 30, 40 years of this tax-free, compounding growth, which can really make a huge difference.
Well, and that's, that to me then brings up a point where we should be, you made a point about diversifying. We should be diversifying. So I know I have both a Roth and I have a SEP and now a solo 401k. But the idea is that I have these different options, so that when I need to pull money out at the age where I'm not being penalized for it, then I have some options like my Roth where I'm not going to have any taxes to pay on it, and the other options, which are bigger, unfortunately or fortunately, to them, they will be taxed, and I have to keep that in mind. So thanks for that reminder.
Yeah, it's always good to have options. When you are retired, you can decide which account you want to pull from. Do I want to pay taxes or not? Or maybe it's both. And at that point, you start playing the income tax bracket game, where you only want X amount of taxable income. If you need to generate more income, you can take it from the Roth. One strategy is to tap into the Roth IRA at the very end, because you're just maximizing how long that's able to grow tax-free. It's also a great type of account to pass on to kids or grandkids. It's changed a little bit as of late with the Secure Act, where they can't stretch it over their lifetime. They have to take it out sooner. But still, it could be, this could be 50, 60, 70 years of tax-free growth, which makes a huge difference. But just having that flexibility and the options is key.
Yeah, I love that. And I know that, we've been talking a lot about investments and retirement, but you do a lot more as a fiduciary and as an advisor than just talk about retirement. What are some of the other things that you help people with when it comes to their finances?
Yeah, so there's a lot of different things kind of under that financial planning umbrella. Investments and retirement are some of the main things, and of course the focus of today. But other areas are insurance, budgeting. Sometimes it's being an accountant.
You mean life insurance?
Yeah, so life insurance, disability, long-term care.
Yep.
I don't do health. I have my health insurance license, but I don't do that directly.
Sure.
I don't do things like
complicated.
Yeah. It changes so often. It's just you have to do it full time. I just can't keep up with all the laws and remain competent with it.
Yeah.
And I don't do things like umbrella or home or auto. Mainly life and disability. Yeah. And that's just part of the protection. That's another thing to be thinking about when you leave your corporate job. Is maybe you had a group life plan at your old company and now that's gone. Right. So you want to get a life insurance policy to protect your family. And similarly with disability insurance, you're 6 times more likely to become disabled than to die. And you actually become more of a liability to your family if you are disabled. Not only do you not have the income, but there's still expenses involved. And so you have to just think through those scenarios, and you hope you never need to tap into your life insurance or your disability insurance, but just to have it there for peace of mind is important.
Yeah. And I think both of those are really key. And I know there are some tax benefits that are available for life insurance plans as well, and disability, especially for solopreneurs and for those of us that maybe don't have a second income in our homes, right? Or don't have a spouse that is earning as well. I think it's a really important point. I just recently got disability insurance, and it's an investment, but it's kind of a peace of mind thing of if anything happens, I like to do things like snowboard and scuba dive, which can result in, who knows what kind of accidents, knock on wood. Oh, yeah. But I think it's important to even keep those things in mind. So I love that you have this holistic kind of view for solopreneurs and all of your clients, not just solopreneurs, but that you get to talk to them about, all these different ways they're protecting themselves in just the security of their finances.
Definitely.
Well, Kevin, if people are interested and they're like, you know what, I want to talk to them. I'm really interested in values-based investing and maybe some of these other things that we've talked about. What's the best way that they can reach you?
Yeah, the best way is through my website. It's alignedfinancial.com, and that's ALIGNED financial.com. I'm on LinkedIn. I'm on Facebook. And my email is right here on the screen as well. So it's the @LPL email. Any of those is fine. Like I said, I'm happy to do a free consultation just to point you in the right direction, help any way I can, whether you become a client or not. The most important thing is just to make sure that you have the answers that you need and that you're on the right track.
Perfect. I love that. Well, we have a couple of questions, and so I wanted to address those. Lillian asked, can I contribute to both my SEP and Roth IRA in a year?
In theory, yes, you can contribute to both. On the SEP IRA, it's going to be a percentage of your income. So depending on the entity type, assuming you're self-employed, you can contribute. It's just a matter of how much. The Roth IRA, it's the main thing is the income. So you can't make over X amount of income. It's about 130 for single and about 195 or maybe 200,000 for married.
That's your net income?
That's actually your AGI, your adjusted gross income.
Oh, your AGI. Okay.
That's not business. That's looking at your tax return, with your spouse if you're married. So if you make too much, you cannot contribute to a Roth IRA. But assuming you're within those parameters, you could contribute to both. Perfect.
Lillian, hopefully that answered your question. Let us know if, there's something else. Annie, this is my mom. Hi, Mom. She said, how can we reduce taxes on pension income besides charitable contributions?
Yeah. So, I'll make some assumptions here. So she's retired.
She just retired this year.
Just retired. Nice. The best way to get deductions is by being self-employed. So obviously when you're retired, you lose a lot of those benefits. Right. Her pension income that she receives is all taxable income. So in terms of ways to reduce it, charitable contributions are going to be, one of the best ways to do that. That's assuming that you itemize your deductions. Right. So, itemize is looking at charitable contributions. It's looking at your state income tax that you pay, your mortgage interest, your property taxes. If all those exceed, it's roughly 12,000 single, 24,000 married, then you can itemize and you can claim those charitable contributions. Aside from that, there's unfortunately not a ton of great options out there, being retired and having that income. So while pensions are phenomenal, they are going away. They're not nearly as common as they were 50 years ago.
Right.
That is another reason why, we want that balance of both pre-tax and after-tax to have, the flexibility of what to draw from. So while the pension, it's probably a good amount, it will last for her entire life. That is taxable money, and there's not too many ways around it.
So she wouldn't be able to, for example, contribute to a Roth at this point, given if she's in that income AGI bracket?
So the one of the provisions is you have to have earned income to contribute to a Roth or to a traditional IRA. So if she had another job where she was, making money, she could contribute to those, and that would help reduce some of the benefits. But typically when people have pensions and Social Security, they've now stopped working.
Right.
That's all considered passive income. It's not technically earned income.
Right.
So you're pretty limited on what you can contribute to. One of the changes with these new laws is that you actually can contribute past what was age 70 and a half. So if you have the income, you can still contribit.
So Mom, you have to just start a side hustle, maybe Indian cooking show. I'm just saying, it's just an option. Or, private speech therapy in my mom's case. She's a speech pathologist. So that's so helpful. Good to know. Kevin, is there anything else you feel like we didn't cover or that comes to mind that we should be considering when we're thinking about just our overall finances, whether it's budget or life insurance or any of these other things?
I think one of the key takeaways is to start early. It's not easy planning ahead. It's money's a very interesting thing. It's, people don't like talking about it. People, may rather just bury their head in the sand than deal with it. But it will pay off if you start early. whether that's on your own or, through the help of myself or another advisor. That's what we're here for, to help make sense of it. And, it can be like another language sometimes. So that would be my main takeaway, is to just start early.
Yeah.
And happy to help anyone I can.
Yeah, I love that. And I just want to reiterate, I know for me, it's been so helpful to have an advisor that even just the charts and graphs you guys have are so cool, right? You can plug in like our current income, how much we are currently saving, and show us like, here's how much you're going to have at age 65, given some, market trends, and see how our portfolio can grow. So I think that's a huge thing. And again, having someone in your corner who is studying this day in and day out and managing your investments for you and making sure that you're maximizing the return on them, making sure they're aligned with the things you care about. I think that's, I know for me, newer, that I've heard the values based finance investing. And I just love that, at any time people can then just turn to you and say like, hey, I heard about this. What do you think about this investment? Because I think people are also, one of the bad things about COVID, and I think also as we just get older, people are coming up with new ways to scam people too with investment opportunities. And so being able to turn to someone we can trust who can advise us against some of those things that might not be wise, to me feels like something that would give me a lot of peace of mind. And I know it has in my experience.
Yeah.
I love it. Well, Kevin, thank you so much for being here. Appreciate your time and sharing your wisdom. And again, if anyone wants to contact Kevin, his info is right here. I love trying to figure out where on the screen that is.
You pointed right at it.
I know. Well, thanks again. And we hope to talk to you soon. Thanks, Kevin.
Thank you so much, Rachel.
Bye.